We're starting with this very important chapter of salaries. We're starting this very important chapter of this salaries, where income tax is now coming and saying we are in step number 4. We are in step number 4, which is classifying your income into 5 heads. Classifying your income into 5 heads of income. I am now into the very important chapter of salaries, where income tax comes and says, boss, if you want to tax something under salaries, there should be 2 conditions satisfying. One condition is there should be an employer-employee relationship. Second condition is you should have received the payment against that relationship. You should have received the payment against that relationship, which means if you receive salary as a partner of a firm, income is taxable under PGBP. If you are receiving salary as an MP, MLA, MLC, it's IFOS. Rahul, you are receiving gift from a manager of your company. IFOS. Receiving gift from a manager of the company. Manager is not the owner. Who's the owner? Employer is the owner. Receiving gift from a manager is still IFOS. If you are receiving gift from the company itself directly, where the company has a policy to do that, then in that case it becomes salary. Now please understand, whenever you talk about salaries is taxable on due or receipt, whichever is earlier. But if you are receiving money in advance, you have to ask yourself, when is the money received in advance? Is the money being received in advance because of a policy? Like for example, if the question comes and says that he is going to receive this money on 28th of the previous month, in that case it is a policy, which means it is taxable on 28th itself. But if the question comes and says, no, he's not received an advance. He's actually asked for a loan. He went to his employer and he came and said, sir, you give me 4 months of loan, I will give it to you back. That is not taxable. He comes and says, sir, you give me 4 months of loan, you adjust it in my future month salary, it will become taxable only in the future month's salary, will not be taxable on loan basis. Because I have to still satisfy my condition of service. That is what the criteria are. Yes. So any kind of salary received in advance is taxable, but any kind of loan taken from employer is not taxable. Any kind of advance against salary given is taxable only if it is due. Yes or no? Then comes something called as arrears of salary. Income tax is coming and saying generally salary and all would have been taxable on due basis itself. What I am referring here is all those salary which you did not even know about because of retrospective change. Income tax is saying that, boss, if there has been a retrospective change in your salary, it will become taxable when either you know about it or you receive it. If you know about it today but you are going to receive it tomorrow, it will become taxable today. If you know about it today, you receive it today also, it becomes taxable today. That is what the policy is. Yes or no? At the same time, I am coming and telling that, boss, whenever you are taxing something under salaries, I am taxing something under salaries during your employment, before your employment, or after your employment also. If you receive a joining bonus before you join, that is also taxable. If you receive pension after you quit, that is also taxable. If you make a change in your employment contract during your policy also, it is taxable. Okay, I don't care whether it is before, I don't care whether it is during, I don't care whether it is after, everything is taxable as long as you can satisfy 2 conditions. Condition number 1, there should be an employer-employee. Condition number 2, there should be a payment relationship. These 2 conditions to be mandatorily satisfied. At the same time, income tax is also coming and telling that, boss, if you are going to receive salary but you choose to divert your salary, it doesn't matter, it is still taxable in your hands because this is an application of income. But if the contract itself came and said that the income was never even taxable for you, or the salary was never even receivable by you, if the policy document itself comes and says that before you joined this company itself, you are never eligible for that salary, then in that case it is not taxable, because then it is diversion of income by overriding title. Which means you need to check whether are you rightfully eligible for the salary. If yes, then it is taxable whether you donate it or not. If you say that you are never even eligible for the salary, then it is not taxable. Yes or no? Look at the scenario. I am coming and saying that any kind of waiver of salary accrued is also taxable as it is only application of income. Example, if I am telling that I have given an instruction to my employer to donate whole of my salary to the charity, is also taxable in the hands of employer as the same is accruing to him. So I am receiving the salary, then I am making a decision to donate, it is still taxable. You can claim an ATG separately if you satisfy the conditions. Clear, everyone? Yes. Now this is your basics of salary. Moving to the format. Moving to the format. Now in my book, this is how the format is. I'm not going to switch my page. We're going to be on this page, and with this page itself, we'll complete the whole chapter. With this page itself, we're going to complete the whole chapter. So I'm going to start from the top. The first item is basic pay. Income tax is saying, boss, whether you have a basic pay, it is always fully taxable. Then you have something called as DA. DNS allowance has two types. One is forming part, not forming part. Forming part means in terms of employment, not forming part means not in terms of employment. Which one is taxable? Both are taxable. Both are taxable. Then you have commission. Commission is two types. One is fixed commission, turnover commission. Rahul, which one is taxable? Both are taxable. Then you have something called as bonus. Income tax is saying, boss, if you have a bonus, it is taxable only when it is received. It is taxable only when it is received. First four items, simple, straightforward. Simple, straightforward. Then you have something called as allowances. Income tax says allowance means those kind of money which is given to you in your hand. Given to you in your hand. You have the money in your hand, then you make a decision whether you want to use it or not. Then you make a decision whether you want to use it or not. Yes, if you have that money in your hand, then in that case you have to decide for an allowance. Then you have to decide for an allowance. Income tax is coming and saying there are some types of allowances. First allowance is called as leave encashment. First allowance is called as leave encashment. Income tax is saying that, boss, when you have a leave encashment, ask yourself if you are receiving the leave encashment during your employment or after your employment. If you are receiving it during your employment, it is fully taxable. Rahul, government case, fully taxable because it is during employment. If you are receiving the money after employment, ask yourself if it is with government or without government. If it is with government, exempt. Without government, least of the four. For those who wrote 3, please note the page number down. It is least of 4. First one is actual. Average salary for the last 10 months. Average salary per month into. That's average salary for the last 10 months. Average salary per month into leave credit unutilized. Last one is a limit of 3 lakhs. Rahul, how do you compute your average salary per month? It is basic plus DA forming part plus turnover commission for 10 months. Basic, DA forming part, turnover commission, last 10 months divided by 10. Then you are coming and saying how to find out my leave credit unutilized. I am coming and saying take your leaves for all the years you worked. Take the leaves for all years you work, but at the same time you cannot take leaves more than 30 days per year. You take all those leaves, then minus all the leaves which you have taken, you will get the number of days you are eligible. Divide that by 30. If you divide that by 30, you will get the number of months you have leave encashment eligible for, multiplied by average salary per month. This is what will become your third part. Yes, with me? Yes. Now, in that they are also coming and saying that the 3 lakh number which you have is not per employment, it is per lifetime. If the number has changed, if you have already encashed some leave encashment and made it not taxable, in the subsequent employments, the number will keep reducing. Yes or no? Then you have leave encashment. Next item is house rent allowance. Income tax is coming and saying that house rent allowance is taxable both for government and non-government. You have least of the 3. First item is actual 40 or 50%. And next item is rent paid minus 10% of salary. Here also salary is defined as basic, DA forming part, turnover commission, but at the same time you can only take it for relevant months. Take it for the respective relevant months. And when you talk about 50 and 40, 50 is for Chennai, Mumbai, Delhi, Kolkata. Apart from that, everything else is 40. Then we have something called as special allowances. Income tax is coming and saying that, boss, if you have some special allowances, we have some items. First item is child education allowance. Income tax comes and says that if you have a child education allowance, it is 100 per month per child, 2 children. Education in India. Child education allowance 100 per month per child, 2 child education in India. Child hostel allowance 300 per month per child, 2 child education in India. Traveling allowance only for disabled child 3200 per month. Apart from this, any other allowances, ask yourself if the allowance is office or personal. If the allowance is office, then in that case exempted up to amount spent. Any other allowance, if it is personal, then it is fully taxable. Then it is fully taxable, with the exception which I told you, allowance and perquisite given to an government employee working outside India, exempt. Exempt. Yes or no? Yes. I'll give you some examples. You tell me whether it's taxable or not. Okay. First item is conveyance allowance. Assuming you spent everything. Assuming you spent everything. Conveyance allowance. Not taxable. Per diem allowance. Daily allowance. Not taxable. Daily allowance is also official purpose. Daily allowance is also official purpose. Lunch allowance. Taxable. Hey, no 50 per million. That is perquisite. This is allowance. This is lunch allowance. Fully taxable. Mobile allowance. Telephone allowance. Medical allowance. Taxable. Medical allowance is also taxable. Medical perquisite is not taxable. Medical perquisite is not taxable. Keep this in mind. Helper allowance. Not taxable. Helper எதுக்கடா கொடுப்பான்? வீட்டுக்கா கொடுப்பான்? Helper is for office purpose. Helper is for office purpose. Then research allowance. Not taxable. Yes, these are some examples. These are some examples. Repeat once again. I will tell you the numbers. Tell me once again. Okay. Conveyance allowance. Not taxable. Outstation travel expense. Not taxable. Again, outstation is for office purpose. Outstation is for office purpose. Research allowance. Uniform allowance. Helper allowance. Lunch allowance. Medical allowance. One more item. Solta. Personal allowance. Taxable. This is what the items are. With me till here? Yes. These are your special allowance and other allowance. Medical allowance. Yes. Next item is retirement benefits. I'm coming and saying in a retirement benefits, the first item is gratuity. Income tax is coming and saying gratuity can be received two types. One is during employment, after employment. If you're receiving gratuity during employment, taxable. After employment, government, non-government, government, exempt. Non-government, check for POGA, non-POGA. If it is covered under POGA, least of 3. Actual 15/26 into last drawn salary into number of completed years or rounded thereof. Last drawn salary means basic plus DA all for which month? Last month. For the last month of employment. If you are non-POGA, then it is least of 3. Actual 20 lakhs. 1/2 into average salary per month into number of completed years. No round offs. Number of completed years will not get round off. Salary here is average salary per month, same as leave encashment, which is basic plus DA forming part plus turnover commission for 10 months. This same 20 lakhs is per lifetime. Yes. Next retirement benefit is annuity or pension. Next is annuity or pension. Taxable. We'll discuss. We'll come to perquisites. Okay. Next you have something called as pension or annuity. Annuity is always taxable. Pension Puerto Rico, we have to check whether you are receiving commuted or uncommuted. For those who get confused, commuted means computed. Which means big number, small number. Big number, lump sum, big number. Uncommuted is a regular pension. Income tax comes and says regular pension is taxable. If you have a completed lump sum pension, which is called as commuted pension, check if you are government, non-government. If you are government, exempt. Non-government, ask yourself if the person received gratuity or did not receive gratuity. If you received gratuity, exempt amount is 1/3 of total pension. If you are not receiving gratuity, exempt amount is 1/2 of total pension. Yes or no? Total pension here is not the pension which you got. It is the commuted pension divided by the commutation percentage. Yes. If you got 60% of the pension and you got some number, you have to find out what will you get if you had 100%. You will have to find out what you would have get if it is 100%. Someone on the chats have written, sir, government employees working outside India and getting allowance is exempt or not? It is exempt. exempt. Yes. Then after pension comes VRS, not a part of syllabus. Not a part of syllabus. Contribution to fund, one of the most important things from exam perspective. The first item is PF. The first item is PF. In PF, you have 4 kinds of PF: statutory, public, recognized, unrecognized. Statutory, public, recognized, and unrecognized. If you have to check, you have to imagine yourself with some cases. First is employer contribution, employee contribution, interest on employer, interest on employee, withdrawals. Withdrawals. Think that concept in mind. I'm going to talk. First one is statutory. Employer contribution exempt. Employee contribution 80C. Interest on employer exempt. Interest on employee up to 2.5 lakhs of contribution interest exempt. Interest above the 2.5 lakhs taxable. Interest above the 2.5 lakhs taxable. Understand. Contribution 2.5 lakhs kila inda adoda interest is exempt. Contribution 2.5 lakhs ka mela inda adoda interest is taxable. Okay, that is what the policy is. Here again they're coming and saying 2.5 lakhs will become 5 lakhs if you are not getting contribution from employer in this. If you're not getting contribution from employer in this, will not generally happen. If you're not getting a contribution from employer, then ideally you would have taken a PPF. You would have not taken a SPF. So it is always 2.5. At the same time, if you're going to withdraw anything from SPF, it is fully exempt. Next item is your PPF. In PPF, employer contribution is not applicable. Employee contribution is 80C. Interest on employer is not applicable. Interest on employee is exempt. Withdrawal is exempt. Come to RPF, notice carefully. RPF, it says employer contribution for the first 7.5 lakhs exempt up to 12% of salary. Exempt up to 12% of salary for the first 7.5 lakhs. What is salary here, Rahul? Basic plus DA forming part plus turnover commission for relevant months. PF is during employment. Therefore relevant months. They are coming and saying, Rahul, within 7.5 lakhs exempt up to 12% of salary. After 7.5 lakhs, everything is taxable. Then they are coming and saying employee contribution 80C. Interest on employer contribution. They are coming and saying for any contribution made up to 7.5 lakhs. 9.5% per annum. Please understand, it is not 9.5% of contribution. It is not 9.5% of the salary. It is 9.5% of the deposits. And at the same time, it is not 9.5% of current year deposit. It is 9.5% of every deposit. Which means in exam, you don't have to worry about the deposit amount. Income tax question they will come and say, Rahul, the person has received 13,000 salary, which is 13%. Automatically you understand deposit was 1 lakh. You will automatically understand deposit is 1 lakh. You can only allow 9,500. You have to disallow. You have to offer to tax 3,500. You'll have to offer to tax 3,500. Everyone, yes, understand this carefully. It is not 9.5% of salary. It is 9.5% of deposits. Coming back, they come and say, Rahul, if your contribution was up to 7.5 lakhs, adoda interest is exempt up to 9.5% per annum. But if the deposit was more than 7.5 lakhs, the interest on that will become fully taxable. But the interest on interest will also become fully taxable. Rahul, how did we do this? We created a box. 4 boxes. Left side top. Average of the all fund. Yes or no? Average of all fund, meaning opening fund plus closing fund divided by 2. Right side is total interest. Left side bottom, average of taxable fund. Right side will give you the taxable interest. Right side will give you the taxable interest. If you do this formula, you will automatically get the answer. For those who didn't understand the formula, can follow the ICA method, which is P1 plus TC1 into R plus PC by 2 into R, where R is I divided by F average, where F average is opening plus closing by 2. Okay, this is what we did in our class. This is the 4 boxes. Top left is average of the total fund. We'll take the total interest. Right side bottom is left side bottom is average of taxable fund and taxable interest. Average of taxable fund and taxable interest. If you want to learn this method, you can open the fast track and you will find the answer there. You will understand what the logic is in the fast track. You can go and check there. But this is how you have to do your taxable interest on above 7.5 lakhs. On above 7.5 lakhs. This is from an employer perspective. What perspective? Employer perspective. Coming to the employee perspective, income tax is coming and saying that, boss, if the employee had contributed up to 2.5 lakhs, it is exempt up to 9.5% of contribution. If it is deposited more than 2.5 lakhs, it is fully taxable. It is fully taxable. Here they have come and not clarified any kind of table and all. They have come and told, we will give you the number. We will give you the number. And the last one is withdrawal. Income tax comes and says, boss, whenever you are withdrawing money, it is generally not taxable if it is withdrawn after 5 years. But if it's withdrawn within 5 years, then in that case it becomes taxable. But generally it will not be taxable if it is any of the 3 scenarios. First one, it is withdrawn due to health or medical conditions. Condition number 2, if the company is shut down for no reason of your default. Condition number 3, you have left the company and you have transferred this PF to an other PF or another NPS. You do any of these conditions, also it is exempt. Otherwise it will become fully taxable. This is what your RPF looks like. Clear, everyone? Yes. Last one is your URPF. In URPF, they're coming and saying, boss, during contributions, nothing is taxable. During interest, nothing is taxable. But during withdrawal, everything will become taxable. How do you tax it? You have to break it into 4. Employer contribution, salaries. Employee contribution, ignore. Interest on employer, salaries. Interest on employee, IFOs. This is what it is. This is what is there normally. But please understand, in your ICI materials, this last part is there, no, interest on employee, which I told as salaries. In ICI material, this is also clubbed under salaries. Interest on employee is also clubbed under salaries. Ideally, this is the wrong answer. But in case it comes in MCQs and you are not able to find the option, try adding your interest on employee. It will be there. So from exam perspective, if the option does not tally without the IFOS case, put the IFOS into salary and try to tally. You will find an option that way. Please be extremely careful about that. Okay. Practical world, it is not there. Practical world, it is always IFOS because it is my contribution, my interest. I will not like to pay it under salaries. But ICI thinks they know better income tax, so therefore it is how the answer is. Clear? Yes. This is what your PF looks like. After PF, you have something called a statutory superannuation fund. In your superannuation fund, they're coming and saying employer contribution is exempt. Interest on employer is exempt. Interest on employee is also exempt. Withdrawal is also exempt. If it is unapproved statutory superannuation fund, it is same as URPF. And the next item is national pension scheme. Income tax is coming and saying that, boss, if the employer is contributing to pension scheme, it is taxable. Because you're going to get a 80 CCD. On that. Yes or no? Yes. This is what your national contribution to funds looks like. Any doubts here? Can we go forward? Yes. If you have completed your allowances, if you have completed retirement benefits, you're now having something called as perks. Perks in income tax means any benefit which is granted to you. With a specified reason. In an allowance, I will give you the money and you can do whatever you want with it. In perk visit, I will give you the specific item. You have to follow the specific item. Yes or yes? Yes. In perk visit, the first item is given as leave travel allowance. Income tax comes and says that if you are planning to travel in India for personal, official. Official is always exempt. I'm talking about personal travels. If you are planning to make a personal travel in India, employer can sponsor your travel. In which case it will become exempt from taxes, provided you satisfy certain conditions. First one, who are you taking? I am taking my self, spouse, children restricted to 2, and dependent parents, dependent siblings. dependent parents and dependent siblings. If you have children restricted to 2, if the second birth was a twin, you can take 3 child. If the second birth was a twin, you can take 3 child. If the first birth itself was a twin, only 2 child. Only 2 child, that's what the policy is. Yes, yes. Then they're asking you, how will you travel? I said, Rahul, I'm traveling by air. They say, economy class ticket is exempt. Rahul, I'm traveling by train. First class AC is exempt. Rahul, I'm traveling by recognized public transport. First class AC is exempt. Rahul, there is no public transport also. First class, similar distance is exempt. First class, similar distance is exempt. Then they're coming and saying, how much will you travel? I said, Rahul, you can only travel for 2 trips in 4 calendar years. 2 trips in 4 calendar years. If you have not used your 2 trips in a 4 calendar years, you can carry forward 1 trip to the next calendar year, provided you use it in your first year. Use it in your first year. Please understand, for your exam it is important because you are in the first year. You are in the first year. Now only your slab started. Your block is 22 to 26. Your block is 22 to 26, which means 20 to 23 there can be one utilization happening. There can be one utilization happening from your 18 to 21. From your 18 to 21. So be careful about it. In your book exam, if they come and say, Rahul, from 18 to 21, they have carried forward 1 trip to the current year and they have made 3 trips in the current year also, you will exempt all the 3. You will exempt all the 3 because this is the first year of the trip. This is the first year of the trip. If you do not utilize the trip in the first year, it is moved out. It is moved out. It is lapsed. It is a one-time limited offer. It is a limited offer. Use it in the first year, then it is okay. If you don't use it in the first year, next year you cannot use it anymore. Next year you cannot use it anymore. Clear, not clear? Clear. At the same time, they are coming and telling that, boss, if you are going for a travel, you can only claim the travel expenses. You cannot claim your accommodation or you cannot claim your food expenses. Cannot claim your food or accommodation expenses. That is something which you have to bear. That is something which you have to bear. Yes. Yes. This completes your leave travel. Then comes your other perquisites. In other perquisites, the first item is medical treatment. Income tax now comes and says that, boss, I am talking about medical treatment. I am not talking about medical allowance. Medical allowance is taxable. Medical treatment is what we are discussing. Medical treatment is what we are discussing. Please be extremely careful about this. Yes. Yes. In medical treatment, income tax is coming and saying you can do treatment in 2 places. One in India, one outside India. If you are doing the treatment in India, I will tell you it is exempt in 4 locations. I will exempt in 4 locations. Location number 1, government hospital. Location number 2, employer's own hospital or employer's tie-up hospital. Location number 3, approved hospital for specified disease. Location number 4, any hospital for COVID disease. Any hospital for COVID disease. COVID is an amendment for the current year. COVID is an amendment for the current year. Rahul, if I don't satisfy any of the 4, it becomes taxable. It becomes taxable. Rahul, who and all can get treatment? I can get treatment for self, spouse, dependent parents, dependent siblings, any children. Dependent parents, dependent siblings, any children. No restriction on the children's here. No restrictions on the children's here. This is what is my condition for India. This is what my condition for India. If you are doing that, if you are doing this outside India, I'll have to break it into 2. I'll have to break it into 2. One is treatment and stay. The other is travel. Income tax is saying that, boss, if you are going to travel, if I find that your gross total income is less than 2 lakhs, travel will become exempt. If the gross total income is more than 2 lakhs, travel will become taxable. Travel will become taxable. Other side, they're coming and saying, Rahul, if you have any kind of treatment and stay expenses, you can get a treatment and stay for 1 person of your family plus 1 attendant. Plus 1 attendant. Attendant need not be your family. No restrictions on that. But the person getting treated should be your family. Person getting treated should be your family. In this case, they're saying, boss, if you're having a treatment and stay expenses, whatever RBI says, I'm okay. Whatever RBI says is okay. If RBI says some amount is exempt, that amount is exempt. Anything beyond that will become taxable. Anything beyond that will become taxable. At the same time, please understand, if the company has taken some life insurance policy on you, it becomes taxable. If the company has taken a health insurance policy on you, it becomes exempt. If the company has taken an accident insurance policy on you, it becomes exempt. Please understand that facts. Please understand that facts. Health insurance, accident insurance is exempt. Life insurance is taxable. Medical allowance is taxable. Medical allowance is taxable. With me? Yes. After medical treatment comes RFA. After medical treatment comes your RFAs. Income tax comes and says that, boss, if I am going to give a house to you, that is called as RFA. When it comes to RFA, you have to split yourself into 2. Check if it is furnished or unfurnished. Unfurnished accommodation, ask yourself whether it is government or non-government. If it is government, license fee. Non-government, check if it is owned or hired. If it is owned, check on salary. check on salary. For your exams, only one thing, 15% of salary. If it is higher charges or 15% of salary, whichever is lower. Now, in this, salary has been defined as basic, DA forming part, all bonus, all commission, all taxable allowances. Basic, DA forming part, all bonus, all commission, all taxable allowances will become your salary, will become a salary for which month? Relevant months, will become for relevant months. Yes, this is what the provisions are. At the same time, if you are also receiving a furnished accommodation, for the furniture or the gadgets which you receive, again ask yourself if it is owned by the employer or hired by the employer. If it is hired by the employer, then it is higher charges. If it is owned by the employer, it is 10% of. Very good. Please understand, it is 10% of cost. It is not 10% of salaries. It is 10% of cost. That too per annum basis. And it is 10% of cost, not on WDV. I don't care what the WDV is. I don't care whether you follow SLM or WDV basis and all. It is 10% of cost whenever you buy it. Clear with me? Yes. At this point of time, they are also coming and saying that, boss, if your company providing 2 RFAs, I will wait till 90 days. In 90 days, if you change your RFA, then in that case, nothing will be taxable. If you don't change your RFA, 91st day, both will become taxable. When I said nothing is taxable, I meant only one will be taxable. Okay, Up to 90 days, you make decision which one you want to tax. After 91st day, both will become taxable. If you are doing an RFA, you can also do something called as hotel. Hotel accommodation. In hotel accommodation, income tax is saying the charges are actual higher charges or 24% of salary, whichever is less. Salary here means same as RFA. Here also they are coming and clarifying that if you have stayed in hotel for 15 days, not taxable. Anything beyond 15 days will become taxable. With me? Yes. After this comes concessional loan. If the employee has taken a loan from employer, benchmarking will happen using SBI rate as on 1st April of previous year. Take the benchmarking rate of 1st April of the previous year, benchmark it with your interest rate, less the difference will become your perquisite. The only thing to keep in mind is this will be multiplied with your loan outstanding at the end of each month. It is not loan outstanding at the start of each month, it is loan outstanding at the end of each month. You have to do this perquisite valuation every month basis. At the same time, they're coming and saying that if you've taken a loan up to 20,000 rupees, not taxable. If you've taken a loan for medical purposes, not taxable. Medical purposes, specified disease also not taxable. Yes. After medical claims, food allowance, food perquisite. It comes as food coupons. Income tax comes and says that, boss, if you're going to provide food to your employees, 50 per meal is exempt. Tea, coffee, beverages and snacks are exempt. Alcohol is taxable. Offshoring food is exempt. Giving food on an offshore location is also exempt. Giving food coupons is also exempt. Up to 50 per meal. But if you are into 115 BAC, it will become taxable. Also it will become taxable. Yes, sir. Next. You have ESOP. ESOP comes and says that, boss, if at all the employee is given any kind of ESOP from the company, you have to benchmark it using average share price in the market, which means opening plus closing by 2. Yes, opening plus closing by 2 on the day on which it was traded. Assuming that day it was not traded, take the last traded. If it is not listed, then it is value. This is what the provisions are. Yes, after your employee stock option comes transfer of movable properties. Income tax is coming and saying when you transfer movable properties, you can transfer 3 kinds of properties. First kind of property is computers or electronics. Second kind of property is motor cars. Third kind of property is other assets. If you're transferring any kind of computers or electronics, it is cost minus 50% WDV method. It is cost minus 50% WDV method for every completed year of usage. No round offs. Second, if it is motor car, it is cost minus 20% depreciation WDV for every completed years of usage. No round offs. If it is other assets, it is cost minus 10% SLM method for every completed years of usage. No round offs. No round-offs. This is what the provisions are. This is what the provisions are. If you're not doing transfer, you're doing use. You're not doing transfer, you're doing a use. Again, in use, you have to take three kinds of items. One is computers or electronics, motor cars, other assets. If it is computers or electronics, it is fully exempt. If it is motor car, we'll discuss later. If it is other assets, it is owned or hired. If it is owned, 10% of cost. If it is hired, higher charges. Coming to the motor car part, they are coming and telling, check and tell me what are you doing. Are you using for fully official purpose? Exempt. If you are using for fully personal purpose, if it is hired, 10%. If it is owned, if it is owned, 10%. If it is hired, higher charges. There is no nothing whichever is lower. There is no whichever is lower. It is owned or hired. If it is owned, it is 10%. If it is hired, it is higher charges. Plus all the fuel and maintenance incurred, plus all the driver incurred, minus whatever you have recovered. The challenge comes when you have part owned and part hired. If you have part owned and part hired, then income tax is coming and telling, tell me what is the CC of the car. At the same time, tell me what is happening from the employer side, what is happening from the employee side. If you come and tell me that, Rahul, employer is owning the car, employer is taking care of runnings and maintenance. Employer is owning the car, employee is running the maintenance up to 1800 cc. Up to 1600 cc, it is 1800 per month. After 1600 cc, it is 2400 per month. At any point of time, if you give a driver 900 per month, I am coming and saying, Rahul, employer owns the car, but I will take care of the maintenance. Employer owns the car, but I will take care of the maintenance. Now I am coming and saying, Rahul, whatever is the 1600 cc, it will become 1600. CC is always 1600 only. CC is always 1600 only. In 1600 cc, I'll come and say 600 and 900. 600 and 900 with a driver of extra 900. Then I'm coming and saying, no, Rahul, if the employee is owning and the employer is running and maintaining, then in that case, whatever is the employee running and maintaining will be fully taxable. In that, I will exempt 1800 or 2400 depending on the CC. 1600 for 1800, 1600 mala pochana 2400 will become exempt. At any point of time, if you are providing a driver, again 900 will become reduced. The whole driver salary will be included, 900 will be removed. The whole driver will be included and 900 will be removed. Last one is if the employee is owning, employee is running, nothing is a perquisite. If you have been given two cars, one car will become part official, part personal, second car will become fully personal. You cannot have two cars which are part official and part personal, not possible. Yes, this is your use of motor car. Then we had something called as transport benefits. If you are working in an airline industry or a railway industry, it is fully exempt. If you are working in any other industry, whatever is given to others, that will become taxable for you. Whatever is given as others will become taxable for you. If you are providing any kind of education facilities, then check if the education is for the employee. If the education is for employee, exempt. If the education is for child, you will check for 1000 rupees. There are two conditions. Condition number one, it should be in employee's school or employee's tie-up school. It should be in employer's own school or employer's tie-up school. In that also, the cost of education should be less than 1000. If it is less than 1000, fully exempt. If it is more than 1000, everything is taxable. And if you are not providing this, you are providing this to any other person, any other family member, then everything will become fully taxable. Next item is gift. Gift comes and says that if you receive a gift in cash, taxable. If you receive a gift in kind, if it is anything less than 5000, fully exempt. Anything more than 5000, fully taxable. You have alternate assumptions. Don't worry about it. Next item is your servant charges, gas charges, water charges, all these things. They're coming and saying that, boss, if it is an specified employee, taxable. If it is not specified employee, not taxable. if it is a specified employee also, if it is a non-specified, if it is a specified employee also, it is not taxable. If ulta, if it is a non-specified employee, it is taxable if you have incurred it and you have recovered it back. If you have incurred it and recovered it back, which means employer should directly give it. If the employer is directly giving it, non-specified employee exempt. If the employer is reimbursing it to you, then it is taxable for non-specified also. Then it is taxable for non-specified also. Rahul, what is specified, non-specified? Don't worry about it. Does not come in exam. Does not come in exam. In case you want to know, you have to be a director of the company. You should have a salary more than 50,000. Should have a salary more than 50,000. In that case, it will become taxable to you. In that case, it will become taxable to you. Yes or no? Yes. This is the end of your perquisites. This is the end of your perquisites. At the same time, in a perquisite, you have to also keep in mind that, boss, any perquisite which is given to you, if it is identified as an official purpose, then it is exempt. If it is not identified as official purpose, it becomes taxable. Rahul, I have been given a telephone for using in office. Exempt. Rahul, I have been given food in office. 50 per meal. I have been given food in office, 50 per meal. Rahul, I have been given medical, what did I tell you? First item, what did I tell you? Telephone. I've been given internet charges. Exempt. All these will become exempt. All these will become exempt. These are not allowances. These are perquisites. These are perquisites. In all these cases, it will become exempt from taxes. Yes or no? Yes. If you complete all these things, you will arrive at something called as gross salary. In gross salary, you have to add one item called as your advance salary or arrears in salary. Advance salary or arrears in salary. You will get up your gross salary. In this gross salary, you have to reduce 50,000 of standard deduction. Item number 2, professional tax, which is paid either by the employer or by the employee. If the professional tax is paid by the employee, directly reduce it. If the professional tax is paid by the employer, you first add as perquisite, then you remove it. You add as perquisite, then you remove it. Last item is your entertainment allowance. It is fully taxable for other employees. Government employees, you bring it on the top. In the bottom, you will reduce least of the 3. Actual 1/5 of basic pay and 5,000. 1/5 of basic pay and 5,000. Here it is basic pay. Here it is basic pay. For which month, Rahul? Relevant months. Relevant months. Rahul, how to remember which month? Keep in mind, if it is a retirement item. If it is a retirement item, then it is average salary for 10 months. If it is continuing item, then it is respective months. There is only one exception to this, which is your gratuity. In gratuity, it is last drawn. For POGA. For POGA alone, it is last drawn. Keep it in mind, and then we'll go for. That will go for. Yes, this will arrive at your income from salaries. This will arrive at your income from salaries. This chapter also has a concept of 89. Doesn't matter. Doesn't matter. Will not come in exam. Doesn't matter. Will not come in exam. It's too complicated to solve in exam, so therefore it will not be coming in exam for you. Clear? Yes. Since we are in this chapter, let's also complete the 115 BSc part. Let's also complete the 115 BSc part. Konja time irukku. 80 minutes irukku. Yes, so let's complete the 115 BSc part. Starting from the top once again. I will look at the item. You will tell me whether 115 BSc eligible, not eligible. Okay. Basic pay. DNS allowance. Commission. Eligible. Bonus. Eligible. Leave encashment. Eligible. Please understand. 115 BSc removes only those items which are recurring. Leave encashment is non-recurring. Therefore, eligible. Then HRA. Not eligible because it is recurring. Then special allowance. Most of the items are not eligible. Only some items are eligible. One is your traveling allowance for disabled. Second is your daily allowance. Third item is your conveyance allowance. And the moon mattum are eligible. Adu thavara everything is not eligible, which means education, hostel, all are removed. Kudutade 100 rupees adu edutha. Yes. Next item is your other allowance. Anyway, it was taxable, so still taxable. Next, come to your retirement benefits. First item is gratuity. Eligible. Pension. Eligible. Voluntary. Eligible. Retrenchment. Eligible. PF. Eligible. Only one thing not eligible, 80C. Not eligible. Then they're coming and saying perquisite. Leave travel. Not eligible. Why? Because recurring item. Every month, every year you will claim it. Therefore, not eligible. In other perquisites, medical eligible. Medical ellame vai ooru irukadra. Yes, medical eligible. Then gift. What is not eligible? Gift was anyway taxable. I am only looking at items which are exempt. I'm only looking at items which are exempt. Gift considered. Then food. In food they are coming and saying normally eligible, but food coupon kurta not eligible. Food coupon kurta not eligible. Office la சாப்பாடு kurta eligible 50 per meal. ஆனா coupon கொடுத்துட்டு வெளியில போய் சாப்பிட்டுக்கோனா not eligible. Not eligible. Clear? Yes. What other items do we have? ESOP eligible. RFA eligible. Transport eligible. Servant eligible. Helper eligible. Everything else is eligible because all are anyway taxable. All are anyway taxable. Then you have advance. It's an item. It's an item. Deductions, Rahul. None of them are eligible. None of the deductions are eligible. You will arrive at your income from salaries. You will arrive at your income from salaries.